All right, hello everyone. Welcome back to the channel. I believe this is episode 9 of my Robinhood portfolio. Today is Saturday, and right now the portfolio is sitting on $13.33 return, and the after hours look great. I got $8 extra in the after hours. I have not done a Robinhood portfolio in a while, so I figured I should probably just start doing this video today, since I'm not doing anything at the moment, and we're going to talk about what I've been doing for the last 2 weeks or so. There's been a lot of changes with this portfolio. There's been a lot of moves that I have looked at and I have evaluated, but we're going to jump right on into it. The markets are really bullish right now. I would say right now the bull market. It was a really good week in terms of production and the overall sense that the market is going up. The bull is still charging. The bears are kind of just sitting back and just watching this fold out. But at some point, I still believe that another correction is possibly coming, and you always want to be ready for that. You always want to be ready for a potential correction that happened just like back in February when the market dropped some 10%. So we're still going to talk about what I have been doing and what stocks have I bought, and some things, some you guys might look at some stuff and say, hey, he may have bought this high, he may have bought this low, he may have sold some stuff. I believe I did sell what's this? Boeing. I did sell Boeing. It got really high. I just looked at it, and then one day I just said, you know what, let's sell Boeing. But I still like Boeing. The only reason why I sold Boeing is because I just wanted to move that money somewhere else. I've been sitting on it for a while, and looking back at it now, I kind of regret selling that stock. I had three shares of that stock for an excellent return. I just figured it was time. The thing about these stocks, about selling these stocks before you get the tax advantages, is that you want to buy and hold. You want to buy and hold onto these stocks, and you want to hold on to them for a year, and you want to get those tax advantages. So I started looking at things differently, as far as maybe trimming my portfolio down and starting major positions in sectors that are just are in sectors that are down, or that I think consumer staples are down right now. I think healthcare is pretty much down. I know AbbVie and Johnson & Johnson, those are stocks I believe that are still at pretty good buying points. I think Pfizer is kind of going up at $36 for Pfizer. I just don't believe that that's a good buying point for that stock. But yeah, I trimmed my portfolio down. I think maybe a lot of people might, disagree about me selling Boeing, and I look back at it now, and I say, man, I should probably jump back into Boeing and wait for a good dip to happen and jump back in. But right now, I like the direction that my portfolio is taking. I'm trimming stuff down. I'm starting major positions in stocks that are on sale, or at least I tried to. And even Apple, I sold off a whole bunch of Apple shares when it got really high, and I moved some money around. And after that, I jumped right back into Apple. So these are stocks that I just personally like. It gets really high, I sell. I try to wait for the stock to come back down, and it just keeps going up. It keeps going up, and I just get mad at myself. I said, you know what, I need to start buying and holding, and I need to just leave this alone, guys. And leave this alone, and do not touch anything. Just keep doing what you're doing. Keep adding money into the portfolio. Keep buying stocks when they dip, and have a good spread. Have a good spread out into different types of market sectors, like tech and technology, healthcare, consumer staples, telecom, even Nexera Energy. That was the stock that I was extremely bullish on, and I thought they had an excellent PE ratio and yield, and even they are gone. So Yeah, there's a lot of changes with this portfolio, and let's talk about Apple here. We're just going to run through these stocks. I don't have a lot of stocks. I only have 7 stocks in my portfolio at the moment currently. Apple, AAPL. I bought Apple high. Like I said, I sold this stock high, and then I jumped right back into the stock because I just love what they do. I just love their spreadsheets, their ratio, their earnings, and I don't agree on buying stocks high, but the reason why I bought this, again, I bought right into the high, guys. Like it's never been this high. It probably has been this high. There's probably been a couple of stock splits, but right now, the 52-week high is 194. My average cost is 193. So I bought this really high, and this can keep trending all the way down. And I have to start approaching things differently. Like Apple's valuation to me is it really doesn't matter where I buy into Apple, because I know that there's just such a great company. And I know that everybody's using these iPhones, everybody's using their technology and their products, and they're heading to $1 trillion market cap, and they're just they're firing on all cylinders, and they're doing some good things that I like. They're increasing their dividends. That the valuation of a stock like this really I just looked at this and I said, why did I even sell this? Why did I sell Apple? And I bought more shares. I bought more shares of Apple, and the portfolio diversity is quite high with all my stocks currently in my portfolio, because I'm trying to establish major positions. But when I look at Apple's valuation at a PE ratio of 18.48, to me, I just do not care where I buy into Apple, because I know that they are always going to continue to generate that revenue and continue to generate all that market cap. So it's a pretty good stock. I like them a lot. And McDonald's has shot up tremendously here. They had a pretty good week. Shot up about 5%, and I bought into McDonald's just at the right time. I had previously sold off McDonald's, so a lot of these stocks that I'm selling off. I remember I had about 3 to 5 shares to McDonald's. I sold those stocks off. I jumped right back into McDonald's when they're sitting at I think it was about 159. But this stock, I guess I jumped in right at the right moment, because total return is sitting on $139, which is really fantastic for the equity of about $2,000. So 15 shares, and I guess when people look at my portfolio, you can kind of see what I'm trying to do. I'm trying to get a dividend payment for each month of quarterly dividends. For example, McDonald's, which will pay, I believe, on June. They had an exit dividend date on June, but I didn't capture that dividend. And I think Johnson & Johnson has one in May, and I believe there's another stock in my portfolio, AT&T, has one in January. So it's really just compound investing, increasing my shares into good companies, good companies that I like. And, I just look at all these other companies and I say, I like their spreadsheets. I like what they're doing. But, I want to put more money into companies that I like, that I trust, and companies that I think they have a global sense of market direction, if that makes any sense. They're global. They're everywhere. And you can easily buy their products anywhere, or use their services anywhere. And McDonald's is a stock like that. McDonald's is exactly a stock where you can find them. You can find them everywhere. They're a worldwide global name. They're all over the world. They're in China. They're in the U.S., United States. They're just everywhere, and they're selling all that food. So I think they're a good stock, a good discretionary stock. If you look at my portfolio, it's really allocated by market sector. You have Apple, which is technology. McDonald's is my discretionary. I originally had Walmart here, but again, I just think that McDonald's has an excellent dividend. They pay a better dividend than Walmart. They know how to make money, and that's not saying that Walmart doesn't know how to make money, but as a discretionary stock that I trust, that I really like, I would say that I do like McDonald's more than Walmart, and I like their platform. I like how they're getting innovative. They're innovators. They want to help. They want to when you walk into a McDonald's, they want you to quickly order the food and get out, and quickly get in and get out without any hassle, without any problems of having to wait in line. And they're getting rid of these lines. They're making everything efficient, and I just like that. Johnson & Johnson is my healthcare, my staples. Procter and Gamble, they're everywhere. I mean, I think this is the right call. I like what I'm doing, but let's talk about Johnson & Johnson quickly for a minute here. $124. I think they're sitting on a good valuation right now. A total return of $90. I got in at a really good average cost. I believe Johnson & Johnson is when it was 120, it dipped down to about $119. Was very undervalued for that price. They're excellent healthcare stock, and I know that a lot of people are talking about Amazon is getting into the healthcare. Warren Buffett, the CEO of Amazon, and J.P. Morgan, they're all getting together and they're trying to get into the healthcare, but the competition is going to be fierce. They're going to have to compete with Johnson & Johnson, which is very, very well diversified in the healthcare industry. This is one of the safest blue chip stocks in healthcare that I can literally think of. They've been paying their dividends for the last 50 years, and this is the reason why. Again, I like the stock. I really, really like Johnson & Johnson for the long term. So I have a lot of equity into Johnson & Johnson. And a lot of people might say, hey, that's risky. 27% of your portfolio is inside Johnson & Johnson. But again, look at what they do. Look at the earnings. Look at the spreadsheets. Look at everything that they do. Look at the market cap. The market cap sitting on $332 billion. This company is going nowhere, guys. This company is not going anywhere. And at $119 and $120, I think they were very, very undervalued for what they do. So it's a really safe pick. I know a lot of people like AbbVie, the AbbVie Corporation, as far as pharmaceutical healthcare, and they could be a potential play later on in the future. They have been increasing their dividend as well, and they have a pretty solid outlook. But again, I like Johnson & Johnson more. I just think that they're just a much safer healthcare stock for my portfolio. Procter & Gamble has shot up here. A lot of people were saying things about these consumer staple stocks, about how Amazon is affecting everything. I love Amazon. It may sound like I'm bashing Amazon a lot, but I love Amazon. I've showed before that I have been in and out of Amazon a lot. It is an expensive stock, but it's well worth the money if you hold on to a long term. But a lot of people were saying about these consumer staples. Nobody's shopping for these consumer staples anymore. People aren't consuming these name brands anymore. They're shopping by categories, and again, I just feel like Procter and Gamble is a solid blue chip staple stock that is just not going to go anywhere anytime soon. They have all those Tide Pods. I know there's been a lot of news about the challenges, which is completely absurd. But they have the potential to compete with anyone, would compete with anyone in their sector. And there are a lot of competition in these consumer staple goods. I look at Kimberly-Clark; they're on sale. Procter and Gamble, they're on sale. But we're sitting on almost a $200 billion market cap, a PE ratio of 20.52, and a dividend yield that's been increasing like Johnson & Johnson for as far back as I can remember. Guys, this is a really good stock that was really on sale. If you had bought the stock somewhere around, I would say about 71, I was actually in this stock about $71, I sold, which that ended up being a mistake. But yeah, if you bought somewhere right in this area right here when it was down 14%, you're sitting pretty good right now. And I'm not really sure why Procter and Gamble received the sell-off. I know a lot of these sectors are on really fantastic dips. A lot of these sectors are looking quite bearish, and a lot of these sectors are looking quite bullish. But again, I'm sitting on Procter and Gamble at the moment, $73 for a total return of $49. I just like the stock a lot. AT&T is a staple in my portfolio, and they do a lot. They do a lot of things. I think Procter and Gamble and AT&T have dividend payments quarterly for the same month. I think AT&T and Procter and Gamble both pay a quarterly dividend in January. So, I'm trying to strategically market this portfolio so I can get some of those dividends. I want to get dividends. I want to compound interest. I want to just keep this portfolio keep pushing this portfolio up into the sky to where I can get this portfolio to $20,000 by the end of the year. But AT&T is a stock that has been shooting up. Again, I still think that they were at a good average cost at a $32 mark. I thought this stock was really, really undervalued. I'm not really sure why a lot of people thought that this stock was going to keep going down. Look at what they do, guys. Everybody has a cell phone. Everybody's using, these plans and all this other stuff. AT&T and Verizon are by far the biggest telecom stocks in the United States. It's not even close. It's not even close how big they are. And a P/E ratio of only 6.83. This stock has plenty of room to grow. Sitting on a 5.07 dividend yield. So if the stock had kept going down, I don't think it really would have mattered, because you would be getting those dividends and just compounding that interest on the dips while you're buying down. Yeah, the stock can keep going down, but a 5% dividend yield is really solid. It's great for a stock like this that everybody has a cell phone. Everybody's using a cell phone, and I just think that they're starting to trend back up. It's just like I said, they're starting to trend back up. Everybody saw how the stock was undervalued, and this could be a play for the merger. There was supposed to be a merger happening soon. I forgot, with Time Warner. Yeah, it's supposed to be a merger with Time Warner. They're supposed to see that is going to get pushed through, and I do believe if Time Warner and AT&T combine or merge, or if they come together, then this stock has plenty of more room to grow, and the stock could really see a valuation of getting back into the high $38 and to about $40. So I'm just sitting on 25 stocks right now. That is a great dividend yield of I think it's about $12. I'm not really sure, but I have to do my due diligence. But it's a good stock. I like AT&T. It synchronizes with all the other stocks in my portfolio. Apple Technology, McDonald's discretionary, Johnson & Johnson healthcare, Procter and Gamble consumer staples, and AT&T Telecom. So we're going to go to the next stock here. I only have 7 stocks in my portfolio at the moment. Southern Company. I had NextEra Energy here, but the thing is, I still really like NextEra Energy. I still think that they are a solid company for what they are doing right now. But I took a look at other utility stocks on the market, and then I came across Southern Company. And if you look at the performance over the year, they were on a really, really good dip at the moment, about 10% dip. I may have bought into this stock a little bit sooner than I would have wanted, but I have been averaging down my shares, and Southern Company, they're one of the better utility stocks on the market. They provide electricity services across the entire United States. They look like they have. I'm looking at their earnings reports right now. I think that's not bad. I think that they do beat their earnings reports, or they're right in line with their earnings reports. I bought in around the 52-week low, so I'm just going to hold it. I'm sitting on a 4%, close to 5% dividend yield, so I don't mind holding a stock when I'm sitting on closing to those types of yields, when they're sitting on a 5% yield. And Southern Company, again, this is not a company that's just going to disappear overnight with a $43 billion market cap. I just believe that they were better. I think that they were at a better buy. I know the PE ratio is quite high, and NextEra Energy has a lower PE ratio. But I looked at Southern Company, and I looked at the dividend yield, and I looked at an investment where I can accumulate shares and get paid a high dividend for holding on to stock. So Johnson & Johnson and Southern Company both pay, I think, a dividend in, I think it's March. So they have a quarterly dividend in March. I think it is March. It may be May. I gotta do my due diligence on that. But the dividend yield looks great. I love this stock. I'm gonna just keep adding to my shares. We're gonna see what happens with the stock. And the last stock in my portfolio currently is NRZ. I believe I had the stock at one point in one of my episodes, maybe in one of the earlier Robinhood Portfolio episodes, maybe like around episode 1, I had NRZ. But this is the riskiest stock by far in my portfolio. The dividend yield is extremely high at 11%. And typically when you see high dividend yields like this, it means that it presents questions on whether or not this dividend yield is stable. There's a lot of risk for the company, such as this one, a small company that's sitting at a $6 billion market cap. But this is, again, the stock market is a risk. You have to, the higher the risk, the higher the reward, the higher the returns. And I looked at NRZ, and they really have been meeting expectations as far as their earnings reports, which looks pretty solid. And their dividend yield, even though it's high, so far it's really been sustainable. Sustainable to pay a 50-cent dividend on a $18 stock. So really, you can use that to an advantage. And I know it's really risky to own a stock like this, but I wanted my portfolio to have some risk. I wanted my portfolio to have a little bit of risk. I know I originally had Iron Mountain here, which had I think a dividend of about 5%, which I really liked. I really like Iron Mountain for the price that I got into, which was around, I believe it was around $32. I'm not really sure how much that was, but Iron Mountain shot up, guys. I ended up selling the stock because it went up, and sometimes you have to avoid that. Sometimes I avoid the dividend to make money. So you can see I've been in and out of Iron Mountain. I bought some shares at $33, and it kept going up, and I've just been selling off. So I took the money and I put it into an NRZ so I can capture the dividend. And I think NRZ pays a dividend of, I think they pay a dividend in June. So the stock is important. So because I know they're going to pay a dividend in June, and they're going to pay a 50-cent dividend. So I think Southern Company pays a dividend in February, I believe. So I got to check that. But guys, that's pretty much the portfolio in a nutshell. There's a lot of major positions with my portfolio. There's a lot of stocks that are gone, and there's possibly a lot of stocks that I'm going to jump into. I don't have any financial stocks at the moment. As far I've been looking at stocks like Bank of America, which is sitting on a pretty low yield, but I still like the stock. I still like Bank of America. Currently, when it was, I had bought into the stock at around $28, but then I ended up selling. But I want to, stocks like Boeing Airlines. I know I had that stock for a while. In the next video, in the next video, that stock might be right back into my portfolio because I like it a lot and it adds more diversification to this portfolio, giving me a solid industrial stock. I think they're actually the best industrial stock on the market. So you can argue that a lot of these stocks are probably the best in their sector. AAPL, Apple, probably the best in the sector. Amazon's there. Healthcare, Johnson and Johnson, they're very well diversified. Probably the best healthcare stock. Procter and Gamble, probably the best consumer staple stock. T, by far, probably not by far, but T and Verizon, the best telecommunication stocks in terms of market cap and growth. Take AT&T has really not been growing these past couple of years, but again, the dividend yield is at 5%, so you're still getting paid either way. And adding a stock like Boeing Airlines is just going to increase my diversification. So right now, the portfolio is sitting on $11,000. I hope to get this portfolio to $20,000 by the end of the year, and hopefully I can manage to do that by buying stocks on the dips, holding out for the dividends, and just making smart plays and buying stocks when I know I trust them, when I trust the company, and I think the company's at a good valuation point. So that's going to do it, guys. Comment if you want to. If you care to comment, go ahead. I try to reply to the comments. I'm really busy throughout the day. And I still check my portfolio every now and then, even though I try not to check this because, again, I really want to buy and hold. I want to hold out for the long term, and I want those tax advantages. So that's going to do it, guys. And I'll see you guys later.